Welcome back to the channel. Today, we're diving into a topic that shapes not just the US economy, but has a ripple effect across the entire globe. The Federal Reserve, or as many call it, the Fed. We'll explore what the Fed is, the types of policies it implements, and most importantly, how these decisions impact the economy. Stay tuned until the end, where we'll also look at a potential scenario of how future Fed decisions could affect both the US and global markets. First, let's quickly cover the basics. The Federal Reserve is the central banking system of the United States. Its primary role is to manage the US monetary system, stabilize prices, and maximize employment. In simpler terms, it controls the money supply and sets interest rates. Established in 1913, the Fed has evolved significantly over the last century, and today its decisions influence nearly every part of the economy. The Fed has several critical functions. Let's highlight the most important ones. Setting interest rates. Through the Federal Open Market Committee, or FOMC, the Fed adjusts the federal funds rate. This rate influences how much it costs banks to borrow money and, in turn, affects everything from mortgage rates to credit card interest. Controlling inflation. The Fed aims to maintain inflation around a 2% target. High inflation reduces the purchasing power of consumers, while low inflation can signal an economic slowdown. Managing employment. The Fed also seeks to maximize employment, though this can sometimes conflict with other goals, like inflation control. Quantitative easing, or QE. In times of crisis, the Fed buys government securities to inject liquidity into the economy. This was especially notable during the 2008 financial crisis and the COVID-19 pandemic. Let's look at what the Fed has been up to recently. Over the last few years, the Fed has played a pivotal role in stabilizing the economy through several crises. In response to the COVID-19 pandemic, it slashed interest rates to near zero and launched a massive quantitative easing program to keep the economy afloat. By March 2022, inflation had surged to over 8%, the highest in 40 years. In response, the Fed raised interest rates aggressively to curb this inflationary pressure. In 2023, the Fed increased rates multiple times, pushing the federal funds rate from 0.25% to 5.25%. These moves aim to bring inflation closer to the 2% target, but also sparked concerns about a potential recession due to rising borrowing costs. Now, how do these decisions impact everyday life? When the Fed raises interest rates, it becomes more expensive to borrow money. This affects mortgages, car loans, and credit cards, slowing consumer spending. On the other hand, higher interest rates make saving more attractive. The idea is to cool down inflation by reducing spending and investment. But there's a trade-off. Higher borrowing costs can lead to slower economic growth and potentially even a recession. For example, housing markets often cool down when mortgage rates rise, something we're seeing now as home sales in the US have dropped significantly in 2023. At the same time, businesses face higher financing costs, which can lead to reduced hiring or investment in new projects. For instance, families might have to cut back on discretionary spending, such as vacations or dining out, to manage higher loan payments. Small businesses, which often rely on loans to manage cash flow, may struggle to stay afloat. Higher interest rates can also affect student loans, making education more expensive for families. In rural areas, farmers might face higher costs for equipment and supplies, impacting agricultural productivity. Even healthcare can be affected, as hospitals and clinics may delay expansions or new services due to higher borrowing costs. Local governments might also cut back on public services and infrastructure projects, affecting community well-being. Additionally, higher interest rates can lead to increased utility costs as energy companies pass on their higher financing costs to consumers. Overall, the ripple effects of the Fed's decisions can be felt in nearly every aspect of daily life, from the cost of groceries to the availability of jobs. Fed decisions don't just impact the US economy, they have ripple effects around the world. When the Fed raises interest rates, it makes the US dollar stronger relative to other currencies. A strong dollar might sound good, but it can be problematic for emerging markets that borrow in dollars. For example, countries like Argentina and Turkey, which have high levels of US dollar-denominated debt, see their borrowing costs skyrocket when the dollar strengthens. Additionally, US rate hikes can lead to capital outflows from these markets, making it harder for them to finance deficits. At the same time, global commodity prices, which are often denominated in dollars, may rise for countries with weaker currencies, affecting everything from oil to agricultural products. Take Brazil, for instance. When the Fed raises rates, the Brazilian real often weakens against the dollar. This makes it more expensive for Brazilian farmers to import necessary equipment and supplies, impacting their agricultural exports. In South Africa, a stronger dollar can lead to higher costs for imported goods, contributing to inflation. This inflation erodes purchasing power, making everyday goods more expensive for consumers. India also feels the impact. A stronger dollar can lead to higher costs for oil imports, as oil is priced in dollars. This can increase fuel prices domestically, affecting transportation and overall economic activity. These examples illustrate how interconnected the global economy is and how Fed decisions can create a domino effect worldwide. Let's consider a potential scenario to see how future Fed decisions could affect both the US and global economy. Imagine that inflation in the US remains stubbornly high in 2024, and the Fed decides to increase interest rates further, pushing them to 6.5%. In the US, we might see further decline in housing markets as mortgage rates hit record highs, lower consumer spending as credit becomes more expensive, a recession risk, where job cuts increase as businesses struggle with higher borrowing costs. Globally, the impacts could include a stronger US dollar, which would hurt emerging markets with dollar-denominated debt, increased commodity prices, putting pressure on developing nations reliant on imports like oil and food. In summary, the Fed plays an enormous role in shaping not only the US economy, but also the global financial system. Whether it's managing inflation, controlling interest rates, or responding to crises, its decisions have far-reaching consequences. As we've seen, these policies can affect everything from the cost of your mortgage to the value of currencies worldwide. Thanks for watching. If you found this video helpful, make sure to like, subscribe, and comment below with your thoughts on the Fed's future moves. See you next time.